All right. Good morning, everybody. TGIF, yeah. Non-farm payrolls today tells us that we can get a liquidity gap. Take the time to explain this every time we get this opportunity. It's 3 times a month. We get an opportunity to perhaps have this setup. It's no guarantee that we're going to get it. And even if we get the setup, there's no guarantee we'll get the follow through. The setup is this right here. This is an example of a liquidity gap. Now you can see various sizes of this throughout a trading day on any time frame. When price suddenly leaves an area, it leaves behind unfinished business. And when it moves really fast like this, it creates a liquidity gap. So there's no gap in the candles. When we say a gap fill and it gapped up, gap down, that's not this kind of gap. It's a liquidity gap. It leaves a vacuum behind. It needs to be filled. And what you'll often find is that we spend the rest of our time working to get back to that gap. Now, we want a single directional push. So I'm going to show you what we don't want in other pictures. In this one, this is a textbook classic perfect example of a gap fill. I highlighted the time because we got back to the gap around 11 o'clock. It was a single directional candle, and then we based. We got through the open and tried to struggle with it a little bit, but we got that gap filled by 11. So that's one example. Here's another example. Same concept, different direction. Single directional candle. Spent the rest of the morning working its way back. And hey, you know what? It got there around 11 o'clock. When I say watch the clock, I'm not kidding. There's nothing, subtle about that. I'm not trying to be cheeky. Watch the clock. Another example where it worked. Now this was broken up into multiple candles, but they still did not back down. They didn't come back and recross where the event happened. It just kept pushing from the next candle to the next, and then we started working our way back, and golly gee, we got back around 11 o'clock. So those are examples of what it looks like when we get the setup and the setup fills. Now, another thing, these are all on the ES, but I've seen the setup happen on both the ES and the NASDAQ and only one fill, like the NASDAQ and the ES didn't, or the ES fills and the NASDAQ didn't. So I'm showing you these on the ES, but you can find it's a price behavior, which means it's fractal in nature, and you can find it anywhere that there is price action on any time frame. This is one that did not work. We got the event. We had big sweeping moves in each direction. The entire thing is just null and void right there. We're done with it. We'll find something else to trade. So we don't want this. If this is what we get, there is no gap fill to play. We're just done with it. Another example, same thing. There just is nothing here to play. Same thing again. Just nothing here, right? So that's the idea. We want a single directional push up or down. I don't care. But we don't want big wicks on each side, and we don't want it to close anywhere near where the starting point was, and we don't want to cross back through that starting point. We get this opportunity 3 times a month: CPI, PPI, and non-farm payrolls. This is from Spot Gamma. This is last month's CPI, non-farm payrolls 8:30 data print. So today we're going to do non-farm payrolls. This was last month's non-farm payrolls. You got the Dixie, the S&P and the US 2-year yields. So when we get that drive in a single direction and you want to trade it, it's not me. I would rather trade the gap close. But I know a lot of people, they see this big push and they think, "Ah, man, I want to trade the big push." Okay. Put the dollar on there and put the 2-year on there so that it can help confirm that you are going to keep driving in the same direction, right? They say price is king, and everybody, likes to use some sort of an indicator. Price is the best indicator that you can get. Price and the clock are the best indicators that you could ever use. So if that's true, price is king and price is the best indicator, then looking at price on multiple instruments seems like the best approach, right? Why would I trade the S&P only looking at the S&P and refusing to look anywhere else? The S&P often is influenced by outside forces. Kind of want to know what those outside forces are doing, right? It's not just will we make a move, it's why are we moving and will it continue? So this would be a really nice setup. You don't need to, this was taken on TradingView, but you can do it on any broker that offers multiple windows, yeah? They will be moving inverse of the market, or they should, right? So if the S&P had gone down, we'd see the dollar going up, 2-year yields going up. Cool, cool. All right, you like it. Here's your levels for the day. Although these are secondary, always keep in mind that when you get an economic data event, your pivot points and key levels for the day, they don't hold any weight. When this non-farm payrolls data comes out, we can shoot 40 points on the ES, and there's no pivot point that's going to stop that from happening. So yesterday's high and low, Globex high and low, measured move, floor pivots, weekly expected move, none of it matters. None of it's going to stop price or even give us any idea of how far we can go. Here's your next level. Now, next week, we've got FOMC coming. And the data that we get today is going to give the Fed cover to do whatever they're going to do next week. The market has told the Fed, "You're lying, we don't believe you," and they priced in 5 rate cuts for 2024. 5. Since the last non-farm payrolls, that's what the market has been working on, and that's why we've rallied with one of the strongest Novembers that we've seen in, what, like a decade or more? It was a record-setting November because the market priced in those 5 rate cuts for next year for the US. In Europe, they priced in 6 rate cuts. The entire world is telling the Fed, "We don't believe you," in markets all around the world. And now add to that, Japan's really looking to change a policy that's been in place forever. And the ramifications of that are just mind-boggling. But the data that we get today from non-farm payrolls is critically important, because if they're going to unwind even half of what they've priced in, this market's going down hard. But if these numbers come in and validate what the market has already priced in, there's been a pause for over 2 weeks as we've been waiting. I think that pause will get pulled back, right? We'll be done with that pause and we'll continue higher. So we're there, right? We're at the point where we could today finally end this stalemate and really start moving. But I'll add one little asterisk here. The data we get is not always clear cut. So there's a third thing. We could get some, general market volatility and price gets yanked around everywhere. And then we go right back into hurry up and wait mode as we wait for FOMC next week. That would happen if the data is not so clear cut that the market believes that they can call BS on the Fed. Because the Fed keeps saying, we're not going to cut. And the market has already priced in 5 rate cuts. So if the data isn't clear enough for the market to firmly stomp its foot and say, I told you you're going to cut, we could just wait in another sideways chopping pattern. So kind of keep that in mind. Europe's up 0.5%. Hong Kong and Japan are flat, which is just a little odd. Russell is at nothing. And the NASDAQ is down the most, slightly more than 0.25%. We do have other things today. Empire State Manufacturing Survey, industrial production, capacity utilization. There's other stuff, but make no mistake about it. It's non-farm payrolls today, baby. And that's the one. We're in blackout mode, so you're very likely not going to see a lot of Fed speakers. But one thing that I caution is keep an eye out for Yellen. She likes to use the quiet period of the blackout time frame because she doesn't have to share media attention with any of the Fed speakers, and she comes out usually chipping her teeth somewhere. I haven't seen her yet, but I know she's lurking around here somewhere. So keep your eye out for Yellen talking trash with treasuries somewhere, right? I wouldn't be surprised if we get a full Ginsburg over the weekend on her. $8:30, 10 o'clock, 1 o'clock, and that wraps it up for us. That rig count, very likely not going to be a very big deal. I worked on those rigs for most of my life. The numbers don't change very often. So we've been talking about last week's candle all week. The discussion being that we needed to stay at the very least above this 50% mark. We've been down below it multiple times. We keep managing to get back above it. How we close today is going to have direct impact on this move that got us here. Now, again, technical analysis comes in second to events. Events always dominate. But this has digested the zone enough that we are no longer overbought if we ever were from this very sudden pace to the upside. And we now have the capacity, like being in the center of the basketball court, to make a move in either direction. And it wouldn't be oversold for a downside move or overbought for an upside move. We have an MDP so far this morning. MDP is a missed daily pivot. It's not my strategy, but if you learn about it, you'll learn why I think it's useful in analysis. Volume's a little light, sitting at 70. If we didn't know why that volume was light, we would want to go hunt down why. Look to see what nations around the world are closed for holiday, what news is causing people to sit out, just flat out, hey, where is everybody? Now we know why, right? We're waiting on non-farm payrolls. So that low volume isn't our concern today. But if you did come in one morning and there wasn't any econ that you knew about and you seen it that light, you would absolutely want to be concerned and go on the hunt and try to find, why is it so light? We know why, so we'll just clear that and get it out of the way. It's done its job. We can see that they're hedging. They're really worried about the move that we're going to get this morning. We know that they're hedging because we can see the market maker move right there. When you come across the market maker move, you want to know, why is it there? Now we know why. It's non-farm payrolls, no big deal. But if we did not know, we'd want to just call time out and go take a look. What's spooking the market so much that they're hedging the front end? People don't buy outsized insurance for nothing. Remember, a hedge is money that you're lighting on fire and throwing in the trash. It's insurance. You never want to claim your insurance. I've got house insurance against fire. I never want to claim it. I don't want my house to burn down just so I can get my money back. I pay the premiums and I'm praying every day that my house doesn't burn down. That's a hedge. That's insurance. So when they're spending money on insurance, it's because they're worried about something and they believe that the money that they're spending on the insurance is money well wasted. We're above the zero gamma, but we're underneath the volatility trigger. When we're underneath that vol trigger, price can expand a lot farther than measured moves and expected moves, and implied volatility says that we should. So something to keep in mind. Candle close to candle close is often greater when we're underneath that volatility trigger. Strategies like butterflies and iron condors are not as effective when we don't stay in containment and we expand beyond our measured moves. Zero gamma, bullish above, bearish below, but we're at that level. So that's not really very helpful at the moment. We're midway between the ADR half, not exactly midway, but this is the ADR half from high to low. We're closer to the low, but really, we're not up or down by much, 0.14%. The ADR half is very close to the 10-day moving average. Don't think for a moment that that is support that can stop this market when non-farm payrolls come out. We can punch right through that like it isn't even there. You see how we punched through the 10 yesterday like it wasn't there, and the day before, and before. It's not support. If we do get through the ADR half, then we'll focus on the Globex low back here. In fact, I would just drop this into a channel with 50%. 45.52. Imagine that, right back at 45.50 again. So if we break that ADR half, 45.50 would be the first target. And then the full ADR would be the second one, which would be that yellow line there. And then last week's low. Now we can take this market maker move and subtract it from this yellow line, and that would give us our market maker move measurement. That gets us to 45.34, which is really close to the cog line, 45.31-ish. And then below that, the 20-day moving average. To the upside, the full ADR plus the market maker move gets us to the call wall. Now that is resistance. It's where we expect a lot of sellers to be waiting. Those sellers can stand aside and let us run through it. And just to make sure that I'm clear on this, when non-farm payrolls data comes out, nothing stops that move, right? So not even that call wall. We're talking about later in the day that call wall could become resistance if we continue to work in that direction. The current December contract in the futures has 7 days until expiration. It's very likely that when we come in Monday, Thinkorswim will have already rolled to the March contracts. If you're on a platform that has to manually roll, NinjaTrader, Trade-of-8, then you're very likely going to want to swap contracts Monday. What I do is look at the volume between the current contract and the next contract out. And when the volume is greater on the next contract, I roll. Right now, the front contract has 129,500 versus 58,000. So don't need to roll today, but very likely by Monday, you're going to want to roll. Right now, the ES has an implied volatility expected move range for today, end of day, 30 points higher or 30 points lower. That's a 60-point range, according to optionalities. It also has a market maker move of $27. So we could round that up and say we have a $57 expected move higher or lower. It's a $114 range. This is showing $60. 67. So pretty close. Big moves. One thing about hedging that's always worth pointing out, especially for newer traders, if everybody's worried about a big move, they will hedge it to the eyeballs, and then we don't get a big move. Now, experienced traders, I'm sure, grasp the logic of this, but moves happen, big moves, big moves happen oftentimes because traders are off sides. They're long when they should have been short. They're short when they should have been long. They're surprised. And then they're scrambling and everybody's chasing to buy or chasing to sell. And that moves price really fast because they're trying to get back into balance. But when you hedge, you're not scared. And it doesn't matter which direction you go. If you're long and then you hedge and it goes down, your insurance is doing its job. The hedge is working. No reason to chase. Right? So we often get these events like non-farm payrolls where everybody is saying, oh boy, it's going to be a biggie. Oh man, it's going to be fantastic. This thing's going to move to the moon. And then the event comes and we get nothing because it was hedged so much that nobody was scrambling and price didn't get exaggerated. So there will be some movement. There always is going to be some movement. But considering that this is the most eventful situation for the rest of the year, other than any surprises that may pop up, this is bigger than FOMC itself, because we already know what the Fed is going to do. They're going to pause. What we don't know from the Fed is what they're going to say about January and March. But we know what their actions are going to be for the December meeting. This non-farm payrolls, there's a lot that can come out of this. So an argument could be made that it is the most impactful thing between now and the end of the year. And it is hedged heavy. 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. The high that we set back here wasn't set when we hit that line and we hit a high and fell away from it. That wasn't the high at the time. It is the high now. If you haven't heard me talk about this before, using this in a look back way doesn't work. You're looking at 10 days of history. This low at the time wasn't the low. We didn't bounce on the bottom of this indicator and come up off of it, because that wasn't the bottom back then. I say that because when you use something like this, you have to grasp what you can and can't do with it. The easiest way to pick up on this tactic is every day at the same time, take a picture. Now, I do these briefings, so I'm able to just go back and watch the replay, right? Watch the replay day after day after day. Take that picture and look at a month's worth of them. And you begin to realize that the only thing that matters is where we're at right this moment and the green background, the volume that is there. None of the price action back here is useful for any sort of analysis of how this price action back here interacted with value area high or low or point of control. We are above that point of control. So after things settle down from non-farm payrolls, if we're still above that level, then we're going to consider that an area of unfinished business. It's where the most trading activity happened. It's very likely that if we go back to that level, there's still traders who want to get more work done at that level. We don't necessarily want to call it support, just an area of interest, an area of concern. It's very likely going to see a lot more trading at that level if we get back there. Otherwise, we're looking to expand. This is a very tight range, especially for a 10-day market. Clear skies, if we can get above 4,600, it's actually 4,611 cog line, but whatever, close enough. And a deep drop below 45.44. So once we break this zone, now there's an interesting concept called draw and raid. We'll just use this area down here real quick. In a draw situation, you get a tight zone. You get a tight zone like this, and they're drawing everybody in, which is the name, right? Think about the way a zone works. When you're in a range and you go short from the high, your stop goes above the range. If you go long from the low, your stop goes under the range. So liquidity resides on the other side of the pivot. And then what happens is we start to expand a little bit more on each side, getting into the liquidity that resides beyond the range, drawing in more and more and more and more traders, building up liquidity around this box more and more and more and more. And then we get usually a fake break in one direction to gather up all of that liquidity, and then a reversal and a complete move through the zone into the other side and the expansion, the raid. So draw, raid the liquidity, make the move, draw and raid. This isn't if I zoom out, there was no raid and there was no follow through, but this was a draw. So I used it for my highlight, but it wasn't an example of a raid and a draw, unfortunately. But take that same concept and come back to this very big 10-day draw. We've been building up liquidity around this range for 2 weeks. Just building it up more and more and more and more. So when we finally leave this zone, it's very likely going to be fantastic. And remember, we talked about the RSI Laguerre. You can gauge that move and see if the move is being done spending the energy that has been built, or if the move is being done to build up even more energy, which I doubt. I'm very sure that the move that we're going to get will happen with the energy that we've built. But it's very likely going to be a doozy when we do finally leave this range. We'll take a quick peek at what's going on in the equities, but honestly, for the most part, there is no reason to even dig around and look at all these other things that are up or down, because none of it's going to matter once non-farm payrolls comes out. Things that were up could be flipped and be down and vice versa. Energy is up. Now, energy fell pretty good this week. So a little bit of, a mean reversion would make sense, that we get, a snapback knee-jerk reaction in the other direction. So that's on the move this morning. And XOP is just more energy. It kind of fits into that. And Bitcoin said it ain't done yet. Can you believe that? It just keeps going and going and going. Bitcoin ain't done. The fangs are down just slightly. Not too significant yet. The dollar and the 10-year are holding against their highs on the session. So in this non-farm payrolls report, you definitely want to watch the dollar. Whether you're watching the 10 or the 2, it doesn't absolutely matter. It doesn't have to be the 2. I put the 2 on there because that's what they showed on Finance Juice when they were looking at last month's non-farm payrolls. I tend to use the 10 more than the 2, but if we're looking at the front end of the curve and that's the Fed's playground, then it makes sense to look at the 2 anyways. And a lot of times in a situation like this, the 2 is going to be the responsive one, right? We want the one that's going to get yanked around. That was a fantastic red to green on Google, but it's kind of setting itself up. This is, I mean, it's kind of gappy, but this lower area can be considered an island. Since we gapped down, we built that island and now we've gapped up. So it's kind of a big deal that we keep this gap up and that we don't close that gap and get back down to 130 anytime soon. Looking at it on the weekly, it kind of cleans things up a little bit, but we're still trapped inside this earnings candle on Google. That's a critical level for anybody thinking about swinging out on this thing. You got to get out of that earnings candle. But if we do, the expansion is going to be magnificent. Just measure that candle and plot it to the upside, and that'll be your swing targets up. Now, I know, a lot of people don't want to buy breakouts and buy the highs. They feel like they're chasing, but Investors Business Daily spent a lot of time and effort on research about how much people don't trade breakouts. And the numbers was like 90% of swing traders don't trade those swing trading breakouts. And yet, how does the stock get to new highs? It continues to break out and break out and break out, right? And just keeps breaking higher and higher and higher and higher. So I get it. You don't want to chase. You don't want to be the sucker that bought it at the top and it falls and you're left holding the bag. But trend trades where they talk about buying the pullback is uncomfortable for traders, especially newer traders, because it's going down and you're trying to buy it and you got to, kind of contend with that. Plus, in a strong momentum market, it won't pull back. It'll just keep going and going, and you're left waiting for a move to get in that never comes, and then you never get in. What bothered me about it at the time was I thought it was a personal choice. Some people like to buy breakouts and some people don't. But it's not actually a choice. It's what are you trading? So if it's Joe Schmo's, lawn mowing service, some junk no-name company, poorly run, with no moat, no good widget, zombie company, bad fundamentals, I'm not buying that thing as it breaks out. It's trash. But if it's a good company, well run, they're managing their finances well, got good fundamentals, strong moat, great product, great earnings, and it continues to get corporate sponsorship, yeah, I'm probably going to buy that on a breakout. So, it's the difference in the thing that you're trading. The Magnificent Seven fit into that category of things that break out that are worth buying. That doesn't mean that every breakout's going to work, obviously, but talking about longer term buy and hold stuff. So I like Google for a fantastic swing in 2024, but we got to get out of this earnings candle. Now, Microsoft didn't wait on anybody. It already broke out. And it gave us a Busby. That Busby needs to hold. So, we can wick down a little bit, but really it's kind of an overlap, 2 for 1. We want to maintain 50% of that previous month's candle. Call it 362. We want to stay above that. We can wick below it. We just got to close above it. And so far, we're looking to close above it. But it's a new month. We just got started. We haven't really had, 1 week? So a lot of work to do, but Microsoft didn't wait. It's already on the move. Apple's right behind it, looking for that breakout. Basically got to get through that round number of 200. But if we do, we can measure this cup and we can project that to the upside. You're looking at like 250. I'm kind of stretching that a little bit. 240 to 245, but still, that's a heck of a move for a swing trade. And it won't be all in one shot, obviously. Although Apple does have a history of just getting out of that zone and making a run for it. And yeah, I'm looking up on all of these, but if non-farm payrolls convinces the market that they pulled forward those rate cuts too soon, then we're going down. I mean, there's no mistaking that. The thing is, this situation with raising rates and tighter monetary policy, and it's 2 years ago, there was a lot of work left to do. I mean, we're kind of getting towards the end of what work needs to be done. Because whether or not the Fed says they're going to cut, the market already sees enough economic tightening from the cuts that's already happened that they can see that the inevitable is coming. So we're nearly done with bad news being good and good news being bad. Once we're finally done with that, we're out of this tightening regime and we can get back to a market that moves based on normal things, pre-COVID kind of market. That'd be nice. Everybody, have a good weekend. Be careful, be safe, watch the clock.